Apple just reported a quarter that looked almost impossible to criticize. Revenue hit $109.4 billion, up 16%. Earnings per share reached $2.02, up 29%. iPhone, Mac, services, and Greater China all grew. And yet, after the release, Apple shares fell as much as roughly 4% in after-hours trading. The easy reaction is, Wall Street got Apple wrong again. Buy the dip. I see it the other way. This was not a mistaken sell-off, and I am not buying this dip. Apple did not suddenly become a bad company, but the two numbers that made this quarter look spectacular have problems. One cannot be repeated, and the other is already slowing down. With the stock fresh off an all-time high, there was practically no room for imperfection. Start with the number most likely to fool you. Apple reported a 50.1% gross margin, which looks exceptional, but the company disclosed that about 2 percentage points came from tariff refunds. Remove that one-time benefit, and the underlying gross margin was closer to 48.1%. The same adjustment applies to earnings. Reported EPS was $2.02, but 11 cents came from those refunds. Without them, EPS was about $1.91. FactSet consensus was $1.89, so the repeatable earnings beat was only 2 cents, nothing like the surge implied by a headline saying profits grew 29%. The refund is real cash. I am not pretending it does not count, but a stock is priced on cash flow next quarter, next year, and the year after that. A one-time refund happens once. You cannot keep applying a 30 or 50 times multiple to the same dollar. That is reason number one for the sell-off. Earnings quality was weaker than the headline suggested. Reason number two matters even more. The growth slowdown is already written into guidance. Revenue grew 16% in the June quarter. For the September quarter, management guided to only 9% to 11% growth. That is not acceleration from a low base. It is a direct step down from 16% to roughly 10%. 10% growth is still respectable for a company producing hundreds of billions in annual sales, but look at the price investors were paying. Apple had just traded near $337, was up more than 20% at one point this year, and had clearly beaten the S&P 500. Before earnings, Morningstar estimated the stock at about 33 times fiscal 2026 earnings and put fair value at $290. A price-to-earnings ratio above 30 is not automatically unacceptable. The question is what you are buying, a business whose growth keeps accelerating, or one whose growth is about to fall from 16% to 10%. Those two businesses deserve different prices. The third problem is cost pressure, and supply chain challenges is not enough to wave this away. On the earnings call, Apple said memory prices would rise again in the September quarter. It also said supply constraints for iPhone, Mac, and iPad would become significantly worse than they were in June. Meanwhile, the tariff refund that lifted this quarter will not support next quarter in the same way. That leaves Apple with an ugly choice: absorb the higher costs and take a margin hit, or raise prices again and hand the problem to customers. Mac and iPad prices have already increased. iPhone may eventually carry more of the cost as well. Apple has some of the strongest pricing power on earth, but Apple can raise prices is not the same as Apple can raise prices without losing sales. When supply is tight, currencies are moving against you, and prices are rising at the same time. Demand gets tested. The fourth problem is services. It did not do the job that Apple's premium valuation requires it to do. Services generated $30.7 billion, up 12.1%, another June quarter record. In isolation, that sounds strong, but services grew more slowly than iPhone at 21.7% and Mac at 28.7%. It also came in below the market's pre-earnings expectation of a little over $31 billion. Why does that matter? Hardware is cyclical. Services is supposed to be steadier and carry higher margins. A major reason investors expanded Apple's valuation over the years was the rising contribution from services. If the business meant to stabilize that multiple starts missing expectations, one excellent iPhone quarter is not enough to push the valuation even higher. There is another number most people will skip: inventory. At the end of June, Apple held $11.09 billion of inventory. Last September, it held just $5.72 billion. That is nearly a doubling in 9 months. Some of it may reflect product launches or more expensive components, so this is not proof that devices are sitting unsold. But with management also warning about supply constraints and higher costs, that jump tells me working capital and supply chain mismatches deserve attention. It is not a conviction by itself. It is definitely not fine print to ignore. Now let me make the bullish case fairly. iPhone revenue reached $54.25 billion, up almost 22%. Mac grew almost 29%. Greater China grew 22%. The installed base of active devices hit another record. 9-month operating cash flow reached $117 billion, up 43%. Apple is not spending recklessly on AI data centers the way some other technology giants are, so its cash generation is cleaner. It still has enormous buyback capacity. And this was broad-based growth, not a shrinking business. Most of that is true. It proves Apple is an outstanding company. It does not prove Apple above $320 is a cheap stock. The real question was never whether Apple is going to collapse. It is how much good news was already priced in. At an all-time high, investors wanted a strong iPhone, strong services, strong margins, strong guidance, and ideally real AI progress too. Apple delivered the iPhone strength, but also delivered a services miss, one-time earnings, slower guidance, and rising costs. When evaluation demands perfection, one crack can be enough to trigger selling. So my 1 to 3 month view is simple, bearish. I am not buying the dip. My base case range is $285 to $305. That is not fortune telling. It is where I think the valuation can reset. Around $290 is close to Morningstar's pre-earnings fair value estimate. Around $300 is a more sensible level for the market to judge September quarter growth and whether new product pricing actually holds up. What would make the stock stronger than I expect? September products launch without major price increases. Demand still beats expectations. The new Siri and Apple Intelligence genuinely drive upgrades. Services growth gets back above 15%, and memory costs stop climbing. In that case, Apple could hold $310 and challenge $340 again. What could send it lower? If iPhone demand weakens after a price increase, September revenue lands at the bottom of guidance, underlying gross margin falls toward 47%, or services growth slips below 10%, then $270 to $280 would not surprise me. Over a 12-month horizon, I am not bearish on Apple the company. I am simply much less optimistic about the stock's return than the market appears to be. My 12-month base case range is $300 to $350. For the stock to stay above $350, I need to see 3 things. AI features moving beyond keynote demos and actually driving upgrades. Services growth reaccelerating, and price increases fully covering memory and supply cost without hurting volume. Miss even one of those, and holding above $350 becomes difficult. If those conditions do not materialize, especially if total growth returns to single digits and services keep slowing, I think Apple is more likely to spend the next year moving between $280 and $310 than marching to new highs. I know the response from long-term Apple holders. Every time you wait for a better price, you risk never getting one. That has often been true, but past returns do not pay today's purchase price. Great companies can still become expensive, and even great business models cannot repeal valuation cycles. Here is my conclusion in one sentence. The market did not misunderstand this quarter. It understood how much of the profit was temporary, and it understood that the fastest phase of growth is fading. I will not buy the first drop after this report. I want to see September product pricing, actual unit demand, and next quarter's underlying gross margin. Missing a rebound only cost me an opportunity. Ignoring a growth slowdown at more than 30 times earnings can cost real money. One final note, this is not personal investment advice. These price ranges reflect my reading of the current results, guidance, and valuation. They are not guarantees. Tariff policy, currencies, component prices, Apple's AI roadmap, and the broader market's appetite for risk could all invalidate this view. Anyone considering a trade should make that decision around their own time horizon and tolerance for loss.